We're back on Cabuto Coast to Coast, and you know, home prices do continue to go up, especially in some big coastal cities. But in other parts of the country, they may remain, relatively flat. Former Fannie Mae executive Tim Rood is with us right now. There's a very good article that sums all of this up in this morning's Wall Street Journal, Tim, and they go into basically you're somebody who lives, say, and the example they use, I believe, is the Scranton, Pennsylvania area. There's such a disparity in what you pay for a house there that if you want to come work around here, live in the suburbs of New York, it would cost you so much it's almost impossible to do. It's tough for people to move around, bottom line. What do we make of this?
Yeah, I mean, I think this is more evidence. I guess this is another good data point in terms of why there was a group of individuals or households that were so compelled by the Donald Trump story. And think about it this way. I mean, so the bulk of most families' net worth is tied up in their house. And you have a class of homeowners, in the case of Hillary Clinton, where they saw their property values. These are typically coastal properties, urban properties, where they've gone up about 115% over the last 16 years. And you get another set of class of borrowers, again, more predominantly the Trump voters, who haven't seen their property values move at all in the last 16 years. And again, if that's your primary asset in your life, that's a pretty troubling statistic. We
talk all the time, and I know from your background, you're used to having these conversations about the, quote, housing market, but there is no one housing market. I mean, it's much different here in New York or in a city like San Francisco than it is in, aforementioned Scranton, Pennsylvania, or a number of other communities like that across the country. So is this a trend you see in any way reversing itself?
Well, it's lumpy, and what you find in these housing markets is that housing follows jobs, right? So if you look at a lot of the urban, rural communities, what tends to happen is that they've been, just as you heard them speaking to, or Donald Trump speaking to them, they haven't had a voice. They haven't seen any private investment. They haven't gotten public investment. As a result, they're not having a whole lot of industrial production jobs. They're finding that their services, community services are down, amenities are down, and people are fleeing. That's the people who can get out from underneath their house.
The problem is, what if they can't, right? I mean, that's the problem. If they can't get out of that area. And so you get a job, you go to college, good school, get a job out, maybe in your local community, but you have a ton of college debt, and you're living somewhere where the housing prices are what we would call affordable, meaning that they're less than they are here somewhere else. And you have a degree in engineering or something, you want to go work in technology out in the Bay Area. I mean, good luck living out there. You can't do it, right?
Yeah, that's where you're starting to see some of these peripheral cities and towns that are actually picking up. So you go from San Francisco, you find yourself in San Jose. You're seeing that in a lot of popular urban areas where they've priced basically most of the millennials and the new employment, out of the market, so that they're finding themselves drawn into these communities. But again, for these communities really to foster, it's going to require the kind of two things, the public and private investment, but it's also going to require regulatory changes on the lending front. The thing is that lenders have been so gun-shy to go into those communities and lend to the downtrodden borrowers, folks who have non-traditional credit, folks who have non-traditional income sources, and are really on the fringe and most risky.
Because of what happened last time around, because of the crisis and all that, you're saying?
It's definitely what happened was that crisis led to this kind of nanny state enforcement regime where I called it was like puppy cradle death syndrome. We've hugged the consumer so tight to protect them that we've broken their neck, because you can't have lenders that are going to go in and lend in those communities, because if that borrower in that community fails, then they're on the hook.
No, I get that. It's weird, though, because at the same time there's a statistic out today and where they look at home flipping. And we're basically back to the pre-crisis levels that people are doing this again. They're buying houses, they're flipping them, they're making a profit. I think it's something like $60,000 on average or something like that. But the point is, you're back to the future. You're back to doing that again. And I thought, boy, we'd never be back in this situation again, but we are. What does that tell you?
Yeah, I was surprised by that. I mean, still, you have assets that are going up 6% a year, and the leverage return on those things are pretty marvelous. But that almost gets back and tells the same story from a regulatory standpoint, is that you've got lenders who are more willing to take a risk on what's called a business purpose loan, where you're investing in somebody who's going to buy a property, fix it up, and flip it, than they would for those consumer loans to the risky borrowers, because the consumer lending enforcement regime has been so terrifying for lenders that the credit risk on the other side seems a lot more palatable than the reputation, litigation risk from supporting low to moderate income borrowers.
Now, we'll have higher rates, right? I mean, they're going to go higher, not lower, I guess. So what does that do to change any of this?
Well, I mean, what you're going to find is, I mean, we've been in a declining environment, interest rates for 35 years, and it's been interesting that in the 3 real spikes of interest rates where you see 100 to 200 basis point spikes over that span, property values actually went up because higher interest rates generally are a reflection of healthy economic conditions. And if people are making more, earning more, and spending more, then they can afford and offset the higher interest rates. What we don't know yet is whether or not that's what we're seeing today. Is we're seeing higher interest rates, but is that going to be supported by higher economic activity and higher incomes to offset it? And we did see in the taper tantrum, if you remember with Ben Bernanke in June of 2013, when rates went up 1%, 2 things happened. You have the velocity in terms of the units sold actually drops 10 or so %. But the rate of appreciation is really the thing that was affected. That came down about 50%. So those are the 2 things you're going to have to watch.
That's what we have to look back on. Okay, Tim, it's always good to talk to you. Thank you. Very good today on a lot of different topics. We appreciate it. Tim Rood.